kicking off next week. So a lot of exciting things going to be happening here in the future. And hopefully this workshop today will get everybody kind of excited about what's to come up here in the next couple of weeks with earnings and, look at how we can capitalize on that with some really great option strategies. So again, thank you everybody for being here, and let us get started. So 1 second here. Hey, glad you're back here, John. So so we've got earnings season kicking off next week with the big banks, JP Morgan, Citi, and all that. And so there's going to be a lot of fireworks. A lot of volatility will start happening. So this workshop today is kind of the first step to get everybody kind of prepared and ready for what's to come. So I'm glad you're here, and let's get started. So first off, a little background on myself. My trading journey, I started back in the 80s. On the oil side of things, was fortunate enough to get in with a company called Coastal Corporation, and they had, at that time they actually had a training program to take people in and teach how to trade. So learn to trade oil, crude oil, all the various oil products, things like that. So it's very exciting. So sent me down to one of the refineries down in Corpus, Texas for about a month. Spent a little bit over a month, I guess, and that was a fantastic kind of learning experience, kind of with the foundational part of the trading, learning about trading oil. So it was great because you could actually experience seeing the oil tankers come in, discharge the crude, run it through the distillation towers and units, kind of being in the refinery, smelling that oil, and then understanding how the products came out of that distillation and et cetera. So great first step in my journey, and ended up in the tanker department from there, scheduling tankers and all that kind of stuff. It was really exciting on that, and then finally got on the cargo trading side on the crude desk, and spent about 5 years at Coastal. They sent me out to Singapore for a couple of years, which was great. Traded a lot of different oil products out there in the Asian crudes, and then got the big Jants or break back in the mid 80s. A company called Trans World Oil hired me as a cargo trader, and at that time they were the largest oil trading company in the world. It was Trans World, Fibra, and Mark Rich, and super exciting times back then. So that company spent about 17 years at Trans World, and about 15, 16 years with them in Bermuda, which was their corporate headquarters, and then ended up running the international trading desk out of Bermuda for 10 years. So it was a great company. We were really at every energy type of market, from natural gas to crude to all the different products, and then eventually branched out and got into all the different futures markets, foreign exchange, things like that. So it was really exciting. That's where I started trading options back in 1987. I'll never forget. We started trading options on cargoes of Brent crude oil. So it was a lot of fun. But anyway, that's kind of the start of my journey. And now I love, trading options and teaching others how to trade options. And so what we're going to cover here today is how to use options for trading various earnings strategies that take advantage of all the pent-up volatility that's coming our way. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So have you noticed how earnings sometimes can be just horrendous and the stock goes up, or earnings you think are off the wall fantastic and the stock tanks? So this is what I call the earnings confusion. So, when a company has earnings conference calls scheduled, many times there's going to be speculation not only into the accuracy of their projected earnings, but also as to other factors coming up. Maybe they're doing something with data centers, or maybe they're going to cut back on, on employees, et cetera. So a lot of things can come out of an earnings conference call, which can really surprise the market and take them, off guard. And that's what creates a lot of volatility in the markets. So it's this kind of uncertainty typically that causes the increase in volatility of the shares that are being traded into an earnings release. And that's kind of the big diamond in the rough. So it's that temporary parabolic rise in the volatility that spikes the option prices higher. So, traders tend to stay on the sidelines going into the days leading up to earnings conference call because it's so crazy. But all of a sudden, then you'll see call buyers maybe coming in, swapping out their shares of long stock for long call options so they can still participate in the rise should the shares move higher, but limiting the potential loss should the shares move lower. So you get that pin up, surge and buying from that. And then in addition to that, you get additional put buyers coming in, forcing the option prices higher as well, trying to protect positions from any major downside move. So it's all this concentrated option buying in many cases will drastically expand the volatility levels of stock being traded into their earnings release. Now, as an individual trader, then you can take advantage of all this uncertainty and volatility in order to capture those profits. So no matter what the crazy earnings reactions are, if you just use the right setup and know when and how to do it, that's all you need to really do. So step one is first to identify and kind of qualify particular stocks by looking at their past performance, their kind of historical performance, and the probabilities that presents of them heading into an earnings season with a different type of setups to do. Now, first we want to find those stocks that have their earnings release also during a weekly option expiration, because for these strategies, they're very short-term in and out kind of trades. You want to be short-term weekly options are the perfect kind of vehicle for this kind of trading. Now, step two is you want to evaluate that past performance of various stocks as they're heading into their earnings. We want to see what the volatility has done to a specific stock previously as it moves closer into its earnings and into its earnings release, and then even after. Now, the prepared trader then is going to be looking for that increase in the stock volatility as it approaches its earnings release. Now, typically a stock normally has volatility, normal volatility around 25 to 40% depending on the stock. But as the earnings or week of earnings comes up, this volatility can easily move to extremes of greater than 2 times the norm. Sometimes you'll see 3, 4, 5 times. So this is what makes a stock potentially a great profit opportunity. It's that volatility that sometimes can normally double. In other cases, can be even more extreme than that. And that's what we're going to be looking for to take advantage of. So here's like an example. This is like NVIDIA. And NVIDIA was back here, look, when it was trading back around 270. This was earnings were coming up on a Thursday, okay, after the close. So this was like on the 13th. So Thursday after the close, and then expiration was the very next day on Friday. So you can see as it was headed into the earnings right into Thursday, you can see the implied volatility here on this option series of the series that's going to be, that weekly series there with 1 day at expiration was over 114%. Now, normally NVIDIA was, volatility around 40 or so right down here, you can see. So it's like almost 3 times more than what its normal volatility is, and that is just 1 day at expiration. So it's really, spiked up because of the uncertainty heading into the earnings release on that Thursday, the 13th. So it was trading at 270, had really high implied volatility, and then let's see what happens the next day. So then the next day you come in and boom, volatility crush. So, all that uncertainty headed in, nobody knows what's going to be the earnings release, what their revenue, if they're going to say anything about anything else coming up on the horizon. And then all of a sudden, that's released. They have their earnings conference call, that uncertainty's out of the market, pop, kind of like a, balloon popping. And you can see the implied volatility is back to kind of its normal range. So in this situation, you can see that the implied volatility collapsed, but also NVIDIA had a price spike from 270 up to 291. So it went up in 1 day, 7.5%. So it had a crush on volatility, but it also had a spike in the price of the option, price of the stock. So that's, what you can typically take advantage of and look for, around an earnings season. This kind of, volatility and how to play it. So here's kind of the chart, just kind of to map it out visually. So here it was going into the earnings, and you can see the implied volatility down here, this teal kind of color. You can see as we go into the earnings, getting closer and closer, the implied volatility keeps kind of rising heading into that day of earnings release right here. So that's one thing you're going to always see. And then here, a lot of times, typically depending on the market, you'll see a lot of stocks will trend into their earnings, if the market thinks they're going to have maybe decent earnings, something like that. So here you can see NVIDIA just kind of flat waiting on the earnings release. Then it comes out after the close, implied volatility collapses, price spikes up, and that's a very typical look for a lot of different stocks, around earnings and their earnings release. So it's for this reason, it's essential then to have a watch list of stocks to monitor closely, due to the fact that not all of them are going to present an equal trading opportunity for you for an earnings trade. So remember, the goal is to take advantage of the temporary rise in volatility, as well as being prepared and looking at past earnings performance to get the probabilities of what a specific stock might do, either price spikes up or down, or play it just for volatility crush, so the probabilities of that. Now the other thing, there are three type of earnings cycle trades that you can look for. So there's the trend trade into the earnings release. That's kind of one kind of trade that we can look for. Then there's the earnings release trade, which is a non-directional trade strategies used for that. And then a lot of times there could be a trend or post-trend, post-earnings kind of trade that you could do after the release of the earnings. So these are kind of the three kind of cycle trades you can look for around an earnings season. So here's a couple examples. So this was like on CRM. And so you can see that trade one was kind of a trend into the earnings date release. So here's the earnings going to be released on this day here. So you can see the implied volatility, this teal line, is just trending to the upside as it's heading towards that day of earnings release. So typically you'll see this happen, 1 to 2 weeks out, you'll see that implied volatility really starting to climb up. And a lot of times you'll see also the price, starting to move up into the earnings release. So here you can see CRM, the trend is just definitely grinding up here to the upside on price as it's approaching that earnings date right here. And also you can see implied volatility is trending up as well. So, the price of the option is going to be based on a couple of things. First, if the price goes up, that's going to increase the option price. But also, if the implied volatility goes up, that also increases the value of the option. So those are two things that go into the option price. And so you're going to get a higher price of the option as you march closer to that earnings release, just from those kind of two components a lot of times. So that's what we're looking for. So that's one. And then what you want to do is, if you do this kind of trade, you definitely want to be out before the earnings are announced or released. You're just going to play a pre-earnings trend trade, either up or down, be out of that trade. And if you're going to trade, the next kind of trade would be just a non-directional trade to take advantage of that earnings volatility crush or big price spikes. Okay, so that's your trend trade one into earnings. And then the second kind of trade would be the earnings release trade. So this is one that you have no idea what price is going to do. It could spike up, spike down. So what you want to do in this kind of trade, we'll look at a couple of different ones, is either take advantage of trading for that implied volatility crush like this, or playing for a big price spike either up or down after the earnings are released. So that's kind of trade two, that non-directional earnings release trade. And we're going to go over a number of different strategies here today on how to take advantage of that. Now then, the third type of trade that can come along is your post-earnings trend trade. So a lot of times, after your earnings are released, you can see here it had a spike down, then a spike back up, and then CRM, after the earnings were released, then tended to trend back up to the upside, kind of like that pre-earnings trend trade there. So this is the third type trade that you can look for and take advantage of a lot of times, that post-earnings trend trade, which could be back to the upside or it could be to the downside. So these are the three types of trades, to get prepared for and to be aware of that are possibilities for you to, take advantage of. So here's an example, another one. Here's like Nike, and you can see it's like trending up. You can see the price here, actually right here, you can see Nike is trending down, but implied volatility had been trending up. And then after the earnings release, what happens? Implied volatility collapses, gets crushed to the downside. And then here you can see another one. You can see implied volatility here just creeping up here, just really trending higher. And then you can see price going into this earnings release is just trending lower, right? And then the implied volatility price earnings come out. What happens here? Implied volatility collapses, and you actually, in this example, had a spike in the price to the upside. So that's kind of what you can be looking for. You can look for the, trend into the earnings release, potential price spikes up, but you're going to always get that volatility collapse. That there are a lot of times we can take advantage of that with certain strategies we can use. All right, so that's kind of another example there. Now, step 3 is to use the pre-earnings checklist to kind of systematize your trade setup process. So, which is kind of most important for making the best trade selection. So I like to keep things as kind of systemized and mechanical as possible. Kind of that helps, to do things the same way over and over, which helps to pull your emotions out of your trading. So you're just trading from just kind of the mechanics of the trade versus your emotions. So really important to systemize your trading as much as you can. Hey, thank you there, Kumar. Just checking some of the questions here. So this is really important, kind of make a kind of a systemized checklist for your trades. So first off, when we're looking at a checklist, what I like to do is, first off, if we're looking at an earnings trade, with the stock must have options and good option liquidity. Also must have high pre-earnings volatility. We want to take advantage of higher implied volatility with some of these strategies. The other thing I like to look for is looking at the past price history, okay? So looking at moves on average that are greater than 5%. A couple different screens that I'll do and I will talk about, but one is looking for moves where we're greater than plus or minus 5% up or down, or where we have a max move of 7% or so, to the upside, or 5% to the upside. So a couple different screens that I'll do for this. And then what I usually will do is I'll look at the screen and be looking for this over the past 4 kind of earnings cycles. So I'll put together a various stock screen with kind of the minimum price on the shares of $30 and higher. And then I do a screen looking for, over the past 4 earnings cycles or seasons for stocks that have had a move of greater than 5 or 6% up, after the earnings release, or a max move of 7% up. Okay, so this gives me kind of a bucket of different types of stocks to play for different earnings strategies. So, if you've got certain stocks that have a tendency for big price spikes up or down, then there's a certain strategy that we'll do. Or if there's a list of stocks that tend to not have a big movement, maybe they move no more than 5 or 6% up or down, then we can do another strategy to take advantage of volatility collapse. So it's really important to do this screen to kind of get your bucket of the different trades to work with. So then the next thing then I'll do is calculate the implied stock move the day of the earnings release to get my profit targets, where I think it can go based on the option data. And then I perform an earnings price target checklist, the upside targets I'm looking for or downside targets based on the implied expected move. And then from this, I can select the appropriate weekly option strategy to use, put my entry plan in place, determine the exit plan, and then, manage the trade. So here's an example of kind of the data analysis I'll go through. This was one that we had done on AKAM. Now, before we get too far into this, I'll be doing actually a really in-depth course actually starting next week on next Saturday on the 17th. So this will be from 11 a.m. Eastern to 2, and then we'll follow up with the part 2 on Tuesday. Now, Monday will be a holiday, Martin Luther King Day, so we'll come back in Tuesday and finish up this course from 4 p.m. to 5. All right, so I've got a really great earnings course here if you'd like to kind of, learn these strategies, and I've got a really great, package for everybody here today. So I'm going to actually give you 20% off if you sign up here today. So let me give you the link here. You can check that out. We'll talk about that a little bit. Any questions, and then we'll have, a more Q&A on this towards the end of the workshop. But use this link here, powercycletrading.com/special, like that, and then put in the promo code will be small cap. You'll use EARN, EARN 20, okay, like right there. Whoops. Let me get back to where I was. All right, so you use small cap EARN 20, EARN 20. Okay, put that in. I'll show you where to put that into the promo code. So you can click on that or copy and paste. And then once you do that, you're going to get this pop-up here will come up. And this is what you can use for this special offer. So it'll come down here and you'll see EARN 20, use that promo code. And I've got a couple different options for you. So first off is course package 1, and I've got 2 options here. Now, just if you want to take just the course, and also with this package, I've got a couple of extras for you that you get a little couple bonuses. But for this course today, the course, when I go out next week, it'll be $197. But if you want to get that 20% off today, it's going to be $157. Okay, with that promo code. EARN 20, and then also with this, for just $157, you'll get a 30-day trial membership to my trading club, which is $97 a month. We've got other packages, but then if you do renew, it's $97, or we have other, like I said, price packages if you want to look some other different things we have. Plus, you'll get access to our live and recorded follow-up support Q&A, which will be a day later. And then also, I'm going to give you my list, 3 different earnings trade lists of some of the best earnings. These are based on the scans that I was talking about a little bit earlier. Plus, in the course, you'll learn how to do these scans yourself. So you're going to get just today for $157, get access to this 4+ hour course, live and recorded. Then these additional extras to help you with your trading. So that's package course package 1, option 1. And then with the additional, if you want all the different bonuses together, that package will be, just $197, so another $40 extra. So you come down here and click on Buy Now. You can see that price says today $157. Click on that, and then come down here. It'll show you everything you'll get with this package. And here, just put that promo code EARN20, small cap. Click apply, and if you want my trading indicators, you can add that to the cart. So 5 different directional studies that I used, available for Thinkorswim, TradeStation, NinjaTrader, eSignal, TradingView. Click that in. Boom, 157 is your price. There you go. Credit card or PayPal. That's course package 1, option 1. Now, if you want all the bonuses, where you're going to get in addition to the 157, just for another $40, it'll be like 197. You can get all the bonuses that I'm offering this course package. So you're going to get my on-demand 4+ hour earnings course that I've done prior. You can start off with that right away. This is $297, on my website, and then you're going to get also my on-demand start trading options today. So this is a really nice intermediate option course that gets you started in your trading. You'll also get that 30-day trial membership, as a bonus. You'll also have access to the live and recorded follow-up Q&A. And then another thing you'll get is how the pros use the Greeks. So this is just on the Greeks of Delta, Gamma, Theta, just another option kind of course on the Greeks. And then you'll also get that trading list of 3 kind of best trade setup for earnings. So this is course package 1, option 2. So with all the bonuses together, just for initial $40. So for $197, you'll get all this in this option 2 of this course package. So just come down here, and then you'll see here buy now. If you want to do this package with all the additional bonuses, click on that. You'll see everything listed as to what you'll get. And again, just put in that earn 20, EARN 20, and click here. You can add to your cart my indicators if you'd like, and that's what you'll get. Now, the other course package 2 is if you want to add my alert service to it. So here's my Elite Open and Close Trade Alert service. And if you'd like this, you can just for another, basically, it's $478. So, for us, basically it comes out to about $2.68 per day. You can add my Elite service to this. So it basically, if you needing more help and guidance in your trading, then this is a great package for you. So with this one, you'll get all 5 of my different trade alerts that I send out over the next 4 months, plus you'll get 4 months to my trading club. So in course package 1, you were going to get a 30-day trial membership. In this one, you'll get my trading club for 4 months, which gives you access to my trading room, a lot of other things we'll talk about, plus all the different alerts that I send out. So there are 5 different types of alerts that I do send out. And I do send out earnings alerts. So this is one that you'll get as well. So, just kind of a summary of what we've done here so far this year, actually I need to redo this, but from January 1st to January 9th, where we are currently now, we've had 137 trades closed out, 90 trades winners. Actually, we've had another ones added to that from Friday. 19 break even, 28 losers, run about an 80% win rate there. And then from the start of the first alert service that I sent out back in May of 2018 through Friday, we've had 969 trades closed out, 688 winners, 74 break even, 207 losers, run a 79% win break even right now. These are all unaudited results, okay? Just kind of a summary, but they give you an idea of what I send out. These trades are, we've been very successful with these trades and high winning probability, which is a really nice thing. So basically what you'll get is when I do send out, there are 5 different types of alerts that I could send out depending on what the market's given us. So you'll get all 5 of the different alerts that I may send out. So you get this for the next 4 months. Now you can start and stop this when you want, because maybe you go on vacation or work or something, so you want to stop your time, you can do that. So typically 8 to 12 stocks or ETFs per month. Now the types of alerts that it would be sent out could be a butterfly or a long condor. We do a lot of those. We do also could be a calendar or counter diagonal. We do a whole lot of those. It could be an earnings trade. So we'll be coming up in earnings season, so I'll be sending out selective earnings trades as well. Or it could be what we call a penning trade, which we use butterflies on. We did one of these this past week as well. Or it could be a breakout reversal trades, which are typically credit spreads. So there are 5 different kinds that I send out. And when I send it out, I'll send it out very detailed guide on it. Then I'm constantly updating the trades to tell you what to do, or when to get out, when to how to adjust, things like that. And we use a service called Telegram, which is a free service. So these come out to you within seconds of when I click send, you get it right away on a text or email. So when I send it out, you'll get a trading guide. I do a trade setup video review at the end of the day on that. Trades are listed in archive. I do a daily video newsletter, and then access to our virtual trading room and 50% discounts on anything on my website. So that's kind of a quick summary. We'll talk about this more a little bit later, but also you get access to my virtual trading room open during the week, and our live and recorded Q&As. So a lot of really good stuff. And if you want this price today would be, using the promo code, will be $478. And we do have a 2-pay if you want. So if you look at the 478, 478, and if you back out the cost of the course, 157, you're basically on a day, you're getting the alert for $2.68 a day. So cheaper than a cup of coffee or a couple of cups of coffee, really. And then if you want that, that's course package 2, option 1. That would just be with the, just the things that I showed you earlier, just the trade list and the Q&A follow-up. And if you want all the additional bonuses in course package 1, that would be this course package 2, option 2, and that's going to be $518. So just basically the $478 plus that additional $40 for those option bonuses, and also you get a 2-pay there. So that's all there is to it. We'll talk about this more later, but then if you do want that discount, come down here to course package 2, option 1. It'll show you everything you're going to get there. And again, put in that EARN20, click apply, and you'll get this my alert service for the next 4 months, plus the course and everything, all the, what we talked about there. And we do have a 2-pay, and you can also, add my indicators if you want. So that's it. If you want course package 2 with all the bonuses, just for additional $40, it'll be $518. And then just do the same thing here. Plug that in, EARN20, and you're good to go. And I look forward to, getting everybody in this course. So just wanted to, go through that real quick. So again, for today, EARN20 promo code. If you want it with just the course and those few extras, it's $157, super cheap deal for everybody. If you want all the bonuses thrown in there, that'll be $197. And then if you want course package 2, option 1 would be the course plus the additions in this package here. This will be just $478. And there's 2-pay. If you want the alert service with all the bonuses, it's $518. So, take advantage of this, and it'll be a great way to start the new year with, this course and the alert service if you like. Now, sometimes you wonder, well, have I purchased this in the past? So a real simple thing to do, go into your members area, and you'll have a drop down on everything that you bought, if you bought anything from us in the future. And if you see your earnings, then you'll know you did have this in the past. So, check that out if you're not sure about, if you bought in the past. All right, so that's kind of a review there. Question, what is the cost of just a trading room? It's $97 a month, okay? Now, if you buy the course today, here's a really great deal. All right, so if you want to attend this course and you want to do it with course package 1, option 1, you can get everything here that I just showed you for $157. Now, with that, you're going to get a 30-day trial membership, 30 days, no charge. As part of the bonus, you get a 30-day trial membership to the trading club, okay? So that's, that's, if you went to the website and you wanted to do that, it's $97. So that's a really great deal. If you want to check out, our trading, our trading club, get access to our trading room, all the different benefits that we'll talk about there. The discounts you can even have, for the next 30 days, you'll get 50% off anything I have on my website. So, for $157 and just, $97, just for additional $60, you can get access to the trading room, plus, all the different things we do. I do a video daily newsletter every day after the close, 50% discounts on everything on my website. So just for an extra $60, you'll get access to this trading course, live and recorded, all the different bonuses there. So I'd highly recommend, if you do want to check out my trading club, to go that route. So here's that AKAM. So just kind of starting back here. So you can see 1 day to expiration here. Look at the implied volatility on AKAM. It's spiked up here to 238%. So that's, normal's about 45 in that range. So that's 5 times the normal volatility for AKAM. So here it is also having its earnings release would be on a Thursday after the close. Okay, and then the option expiration is the next day. So you can see here the implied volatility on this had spiked up to 238, and the expected move going in, the market was expecting based on the option straddle costs and the implied volatility, the markets were looking for 9.4% move up or down. That's one standard deviation. But here, if you look at it, 238 and the normal implied volatility is 45 or 50. That's 5 times the normal, okay? So that's basically 5 standard deviations above it, based on that implied volatility. So here's AKAM, then the next day, you can see the next day after the earnings release, look what happened to the implied volatility. It's still high, but it's collapsed down to 134 from 238. And you can see that then also the price, you can see the price now, the next day was trading at 77.94. It was down over 20%. So these are things that we're looking to take advantage of, so there's certain stocks that have a tendency for these big moves, and those are going to be the ones that we'll get on our, screening list that we'll use, and then we can trade these stocks with certain strategies. All right, so then, what I'll do is I go through my data, and here's my earnings history data. And you can see here, this is based on the straddle price going into the earnings. You can see that over here is the percentage of it. So you can see normally AKAM has historically had huge moves, after the earnings, okay? So, here it was 10.82% was the implied move going into earnings, 9.47, 12.6, 9, 6.5. So typically the AKM has potential for big price spikes based on past history. And then what I like to do is what did it actually do after the earnings and at the close of that week. So here it is with AKM, the day after earnings, and where it went out at expiration. So you can see that it tends to have really big moves. And so you can see going into the July series we were looking here, this was back in the November. It was, you can see here, it closed down 21% there. That was the one just looking at the earnings season before that. Closed down over 14%, up over 10%, down almost 11, down 8, and there's one small one. But the tendency for this, based on its history and data, is that it has huge potential moves, either up or down. So we'll take advantage of that if we know the probabilities of this particular stock has that tendency for big price spikes. So, then I put this on a worksheet so you can see a little bit better. And you can see here, just from going back in this example, 5 cycles, you can see here's the closing price, and then here's the implied move pre-earnings history. So, looking back at the earnings history, the implied move based on the straddle cost going into this November earnings market was looking for a move up or down of 9.4%. Prior to that, 12.66, 9, 6, 9.83. So taking that and looking at that on an average, you can see it has an average of about 9.5% expected implied move up or down. But here's the interesting thing here. So then if I look at what it actually did at expiration on that weekly option, you can see it actually had moves right in line or sometimes even bigger. So here you can see this series, it actually closed down 14%. This one, it closed up 10, down almost 11, down 8. And this was the one outlier right there. So you can see this is also, I looked at an average going back 9 cycles, and over 9 earnings seasons, AKAM, that had a move on the average of 10.55% up or down on its earnings after its earnings release at expiration. And the smallest move was that one time at 1.56. So you can see then the winning probabilities. If you looked at, this 5 different cycles, and you have, one where you have one loser, or if you look at 9 cycles and you have one loser, you've got a really high winning probability of that trade, right? So, over 9 cycles, you only had you had 8 winners out of 9. That is a pretty good win rate. So that's about an 89% win rate over 9 cycles. And so what I like to do then is look to set in this kind of trade, I'll set a kind of for a strategy for a price spike up or down, which we'll look at in a minute. And I'll typically do that. All it needs to do is try to move 5% up or 5% down or 6 like this. All right. So if you can see here, on average, it's moving over 10% up or down. If we could set the trade up where all we have to do is it has to move either 6% up or down, then we have a real high probability of that trade being a winner. All right. But we get that from our earnings history, our screen or scan that we'll do to pick up these types of trades. And that's what you're going to get also with this course. For 157, you're also going to get the list of my 3 different earnings type trade strategies to use. Okay, so that's a big thing to remember there. Now that step 4 is the power of weekly options. Now, I like to use always weekly options for these earnings trades to take advantage of the 2 kind of key pricing components, which are time value and the implied volatility. So the combination of these 2 components, when used, correctly, this is what's going to create a low-cost, defined risk trading formula we can use to give us really high returns in a very, very short period of time. So these trades are kind of exciting because it's kind of like what I call lightning in a bottle. My first boss on the trading side of things, on the oil side, when I got hired at Coastal, he used to get excited about trades when we had a really big winning trade, and he'd say, gosh, this is like lightning in a bottle. I just want to bottle it up and have it each and every time. So that's how these trades can be. They can be very exciting, explosive. And so, you just kind of want to bottle it up if you can. So if you just know then which weekly option strategy to use for the trade, the earnings trade, then how to construct it, and then when to trade it, then these weeklies can really produce some exceptional fast profits due to the great leverage they provide, making them the perfect trading vehicle for your earnings types of trades. So let's take a look at how to pick it out. So it's what I call a comparative option strategy analysis. So when constructing the earnings trade, the thing I always look at is the risk to reward, or the return on my capital at risk, between the various strategies that could be used for a earnings trade. So I look at the then and pick out the one that has the best risk reward kind of ratio to it, that matches my trading goals or your trading goals, and then I'd select that trade. So sometimes there'll be more than one strategy that you can use, and so this is a really important part of the trade process, and this is what we'll go through in the trade course as well. All right, so now the next thing is, what are the strategies? So there are 5 different option strategies that can be used to capture these kind of profits from the extreme volatility that surround the earnings season. So now each strategy works best based on certain circumstances. So these are the strategies that I'll typically look at, or the kind of the go-to strategies that we'll look for to use. So there are 5 different ones that we could go to. So the first one, and we'll go through this, is a short iron condor. So this is actually a debit spread where your total risk is your debit paid. And this strategy is used for big price spikes up or down. So like in that AKAM example, it has a tendency for big price spikes. So this is a strategy that we're going to use to take advantage of that. So big moves up or down after the earnings release. Now the second one is what we call the long iron condor spread. And this is actually a credit spread. Okay, so this is one we're going to use for volatility collapse. As you know, as you go into earnings, implied volatility is always going to go up because the uncertainty to that stock as it heads to its earnings release. So implied volatility goes up. What happens after the earnings release? It goes down because all the uncertainty is taken out. So that's what we call volatility crush. So this is a second type strategy that we can use. And we'll go through that in great detail in the course, how to use it, when to use it. The third one is what we call the long iron butterfly. So this is also a credit spread strategy, also designed and constructed for volatility crush. The fourth one is what I call the double lightning. This is a really, really cool spread that we've been using. And it's also a debit spread for your defined risk as your debit paid. But the great thing with this one is kind of what I call a flexibility trade, because it does a couple things. First, it will take advantage of that volatility crush, but also it gives you a potential to trade or stay in for a post-earnings trend trade. All right, so a really cool setup for that. We'll go through some examples how it works. And then the fifth one is the earnings pairs trade strategy, a really cool strategy for trading any post-earnings trend. And so this is going to be a spread trade or a pairs trade where you're long and short to just play a post-earnings trend. So these are the 5 strategies, and I'll give you a little sampling of those today. And then in the course, we'll go into these in great detail of how to use it, how to scan for them, how to select the trades, and go from there. All right. So the first one is the volatility crush strategy, and this is a long iron condor credit spread. So it's a defined risk trade, but it's also a non-directional earnings release trade. We don't know where price is going to go. We don't care. This is designed just as a non-directional trade to take advantage of volatility collapse. So it's a new screen that I also do where it gives even a higher probability. I'll show you that in the course what this is, but it takes advantage of that pre-earnings high implied volatility. And basically what it's doing is taking advantage of selling time and volatility and profits from that volatility collapse after the earnings release. So these trades are very short duration. These can be, 1 day to maybe 3 days is kind of as far out as we'll go on these types of trades. So here's an example of one from JP Morgan. So this was the long iron condor credit spread for volatility crush, and this was one that we'd set up on JP Morgan, just go through it as an example. So here you can see the kind of the history, the data I use, and I'll show you in the course what this data is, how to use it, how to analyze it. But here you can see the implied expected move history is, JP Morgan doesn't have huge moves after its earnings release. So typically around 2.5%, 3%. So not a big mover. Okay, so this is kind of one bucket that I look for. Those stocks that don't have big moves. So then we can play that volatility collapse. And so then you can see the day after its earnings release into the expiration, JP Morgan was down 1.2%. Here was a little bit higher than normal, up about 6 or down 6, flat, up 1.5, flat, up 7.5. But the tendency is not for huge price spikes like that AKM, which could be 20% or 10% or whatever. So typically not a big mover. So that's what we want. And then to take advantage of the high implied volatility, we can do this kind of strategy to take advantage of that volatility crush. And so here you can see on JP Morgan, just to kind of illustrate, here it is going into the earnings release, 1 day to expiration. You can see the implied volatility here on that series is 73%. And normal is very, very low. You can see here, normally JP Morgan's around 20, 22. So very, very high based on normal volatility, about, 3 times or even greater than norm, okay? Now, then you can see the next day, this series that, this is going into expiration the next day after. Look at the implied volatility. It's collapsed back down to what the normal kind of volatility of the trade. All right, so that's the JP Morgan. So take advantage of that. We're going to do this iron condor credit spread to capture that volatility collapse. So here's the trade setup. The entry was on the 11th, so that was a Thursday. The trade was going to be before the market opened, actually after the close, the next day. And then you can see the next day on the 12th, on Friday, the trade had gone from 207.57 and dropped down to 205. So it was barely down. It was down 0.79%. So perfect setup for selling volatility. We don't want a big move. Okay, so here was the upside. We'd sold an iron condor, selling the credit spread side was a short strike at 217.5, and the put side was credit selling the 200 strike here, playing that volatility for collapse there. So let's take a look at how this worked out. So the key thing here, though, is getting the right setup, the right trade based on history in order to match it to the right strategy. So here was this trade on JP Morgan. Going into the trade, it was traded at 207.57. The next day, it collapsed down and priced just to 205.93. Going into the trade, the implied expected move was, the market was saying it was going to be up or down 3.12%. That was one day. Now, I looked over the last 5 cycles, and you can see it doesn't, it's around that level. I want to make sure on this kind of trade, it's not one for big price spikes of 10, 15, or 20%. So this is a very low volatility spike or trade setup where we can just trade that volatility collapse. Okay, so then on the next day, this trade was up $45 per spread, or 22% return in one day. Now, these are, probability trades again, and these are based on, looking at prior history to see what JP Morgan does. In this one, typically JP Morgan does have big moves, but we want to sell volatility. So this was the trade setup. So it's done for a credit, like an iron condor. So it looks like this. You're selling a credit spread, a call credit spread, and a put credit spread. And we want that sucker to go out in here to keep the full credit from the crush. All right, and that's exactly what we got with JP Morgan. So you can see here, the short call, we had the short call, the 217.5, had a delta of 11. So it was way out of the money, high probability that the price would be below 217.5. And then the short put had a 16 delta. So we had these were probability trade for setting up for the short strikes being way out of the money, high probability that price would close between the two. All right, so just taking a look at that, and that's exactly what we got. So the homework was, okay, let's look for volatility collapse. This was the trade setup, and it actually went right out right there. So it's the perfect trade. So we had this trade where we had the total credit of 23 on the credit spread side of the call, 22 here. So we had, you can see here the $45 was what we got from the credit, and then based on the amount of risk on the trade, we had a 45% kept full credit here, and that risk was the difference between the spread of $2.50. Okay, so that's how that one worked out there. So that's one, but specifically designed just to play volatility collapse. Okay, so that was what, $2.50 wide spread, and our credit was 45. So the risk was 205, and the credit was 45. So that's a return there of 22%. Now, again, these are based on the probability that JP Morgan is not going to be a big mover. And based on that, we set up this iron condor credit spread. Okay, so that's one way to trade it. But it's, again, you've got to pick the right stock to do these types of trades. Now, the next one, these are some really exciting ones. This is the strategy used for very explosive price movements. And this is the iron condor debit spread. So we've been using actually a lot of these over the past couple of earnings seasons because the volatility, and there have been a lot of stocks that have had big, huge moves either up or down. But again, this is also a defined risk trade. It's based on the debit spread. So that's your risk, is your debit paid. Again, non-directional. We don't care the direction. We just want to have this kind of trade to have big, huge moves up or down. And so we're going to go through the history to pick these out, go through the scan, give us a list of stocks, then we'll analyze it and pick the best one. So then takes advantage of that earnings release price spike, profits from the explosive moves up or down, trade duration, very short duration, either 1 to 3 days out. Here's one that we did. This was the last earnings cycle. This is one that we did on Affirm, AFRM. So this one was an earnings alert trade. So if you do sign up for course package 2, where you'll get my alerts, this is one that we did last earnings cycle. So this was back on the 28th of August. The Affirm, this was in the last earnings season, was traded at 80.50. So based on the earnings history, Affirm has potential for big price spikes up or down. All right, so we did this, and you can see it's very, very detailed on how to do the trade. I won't go through this, it's kind of long, but so if you've never even done a trade, you could read, you could read my detailed price trade, summary here of what to do, and you could actually do the trade, okay? So this is on the 28th, you'll see it'll say new Affirm earnings iron condor debit spread, and then I go through all the different variations there, and then here's the trade setup. Down here I said to, based on where it's trading, buy one iron condor, and this was buying the 83.85 call debit spread, and then the put side was the 77.75. Anyway, so very detailed, but these are really designed just for big price spikes. And then you can see here the next day, Affirm was trading at $94. Okay, so when the trade was set up the day before, it was 80.50. The next day, it was trading around 94. So we had a max profit on this trade setup. All right, so this was a pretty cool trade. So here it was, looking at the earnings history again. You can just kind of go through this and see it. It has the potential implied expected move history is for big, huge moves here, 12%, 13, 16, 20, etc. But then what does it actually do? It also, then past history, you can see it's had big moves. So the next day at expiration, it was up 10.58, down 0.14, up 21. That was an outlier, small one, 4, 31 up, 10 down, etc. So this tells us, or tells me, if I'm going to do this trade, I want to do this one for big price spike up or down. And so this is the trade strategy to use on this type of trade. So just kind of to clarify, you can see the data even more clearly here. You can see here was going into the trade, it was the market was looking for a move of 12.81% up or down. The cycle before that was 13, 13, 16, 15. So on average over 5 cycles, the market expected implied move was for movements up or down of over 14%. But look where it came in over the actual 5 expirations. On average, this thing was up 16.7% up or down. Okay, so huge mover, and you can see over 9 cycles, it had an average of 16.32% up or down move, with the smallest move 4.73. Right, so high probability trade based on the past performance, and that's what I like to look for. And then I put this in that bucket for these price spikes, and then set the trade up based on looking for a price spike. And this was the trade setup that we did. So we had the trade set up going in. We set this up before the close that day on Affirm. Price or the earnings were going to be after the close. So this was the 28th. It was trading at $80, and then the next day we got out. It was trading at 88.45. We had max profit here. You can see it initially had a huge spike up here to 100, pull back, but we're still in great shape. So here was the trade setup, what we had on. So we had this call debit spread, iron condor debit spread on. So basically this cost of the trade was $150, $1.50 debit per spread for one spread. So our cost, if you did one spread, was $150. And you can see it ended up closing right here at 88.45. So that gave us our max profit of the difference of $50 per spread. That's 33% return in one day. And again, this is based on the post-earnings history, the earnings history showing that AKAM has a tendency for big price spikes up or down. and got this from our list, a scanning list that we put together. And I'll teach you how to do that in the course, the scan and how to put the list together. So that was an example there. Now here's the other type of trade strategy. This is a really cool one that we use. This is what we call the double lightning or the double calendar. So it's a very, very, very low risk but high reward type of earnings trade setup. It also gives you the flexibility of keeping the trade if you want to trade it post-trend, post-earnings release, okay? Now, so this one gives you very, very low risk that you're going to see. Again, it's non-directional going in. Again, it's going to be structured for low defined risk, takes advantage of pre-earnings high implied volatility, and then takes advantage of that time and volatility collapse after the earnings release. All right, so profits from that, but also then allows you, if you think it's going to trade, it allows you to keep the trade for a post-earnings trend trade. The trade duration on these can be, 1 day out to a week. Sometimes we've gone further out, but typically 1 day to a week. Always a positive theta, no time decay. All right, so this sets this strategy apart from the others that also sell volatility. So because it can be adjusted into that directional trade after the earnings release. So that's going to give you that potential for big profits from the post-earnings directional move. So I started using this one with the alert service back in 2020, and we've had just outstanding results. We're like an 85% win break-even rate using this strategy. Now here's an example of how it works. This is one that we had done on STZ, doing this double calendar or double lightning trade that I kind of nicknamed it. So with this trade, we're looking for a move, not to be a huge move. We're looking for kind of cap moves like the iron condor credit spread. So you can see here, the STZ doesn't have huge moves. Tendency is, the implied expected move is 4% or a little bit below, okay? So what I like to do then is look at history. Where did it actually go out at expiration? And I want it to go out close, on a historic basis, looking at what it's done, have it close to what it's done on its implied move history based on the straddle cost. So you can see here, 4 to 3.5%. And so then you can see at expiration the day later, STZ has not had huge moves, but it does move. So we don't want it just to be flat. We want it to kind of move a little bit either up or down towards the implied expected move side on the upside, or the implied expected move on the downside. And then we set the trade up based on those targets being hit, or somewhere in between, because it's got what we call a low kind of area in here, which even if it goes out inside of the call side, expected move or put side, it'll still make a small profit if it goes out here. And if it goes out here, the losses are very, very small. That's the thing that's great. These are very, very super low risk, but can be really high reward payoff type trades. So here's that double calendar that we did on STZ. The expected move going into this trade when it was set up was the market was looking for 3.5% either up or down. And we set the trade up just for a movement up 3% or down 3%. Taking advantage of this using the implied volatility, take advantage of that crush. All right, so we got into the trade. It was trading at 242.33, expiration the next day. And you can see it went up to 247.51. So, it was up a little bit, not too much. This was kind of the perfect setup for this trade. So here it was going in. You can see we had that elevated implied volatility here of over 86% on STZ. Normal implied volatility, around 25. So you can see it's 2 to 3 times more than what it normally is, and over 3 times actually. And so this was a great setup for that. And so we set this up looking for either a small move up or a small move down, and set this up. You see then the next day after the earnings came out, had that volatility crush. Now it's back down to its normal. That's what we're looking to take advantage of in this kind of trade. All right, so it's mashing the right option strategy with the data of what a specific stock may do And that's how we, do these trades. So here was the trade setup. Now this one was one that we set up for a total cost of, here you can see we were looking for a move up here. The trade, the implied expected move, market was saying, okay, 3.5% up or down. So we set the trade up for move either up 3%. Actually, we set the trade up plus or minus 3%. We set it up for a 4% up actually, and down 5% on this. All right. So in the course, I'll teach you how to set these these ranges using the option model. So we set this up for a move up 4% or a move down 5%. And so that gave us the short call option strategy right here. We were short the 247.5 right here. And then, I'll show you how it works in the course. And then we had the put side at 235 there. So with the way this works is that we're selling the front and buying the back, and we're playing that implied volatility skew. Okay, so this in the course I'll teach you how that works. So we were targeting this trade just a 4% up right here, so that we were targeting that based on where it was trading the day before. That would be a move to 247.5 right there. Or we were targeting a move down 5%. That would be to 235. And so, I'll explain and show you how I get these kind of numbers, how to set this up based on the implied move. And what we do is I look back at history to see what it's done. And with this one, it had a tendency, it had bigger moves to the downside. So that's why I set the downside target a little bit further, 5% down versus the upside. So anyway, we had it move, almost to the penny. It ended up closing up at 247.5. So this was, it's kind of like a butterfly. You think about a butterfly, you get a pin. So we actually had a pin right there at 247.5. So the total trade cost was the debit cost. So we had $75 on the call side. That was our debit cost. We had $75 on the put side. So the total debit cost, the total cost of this trade was $150 debit cost, right? Now, if it went out in between here, you can see it still makes money. Here's your zero line. So this still would have made about 25, $30 a trade. And you can see your break evens are way out here. So very, very, very high probability trade to win or break even. All right, so then this thing blew out, and now the spread was trading at 330, and we had a cost of 150. So this one made $180 per spread, 120% return in one day. So a really cool structure. And then what this allows you to do, if you did want to keep the trade, you can see that you are long the 12 Jan 247.5 in this trade, and we were short the 5 Jan, which was the next day expiration. So if we had wanted to keep this for a post-trend trade up, we could have just closed out the put side and the short call and just left the next week long open, the 247 open. So that gives you that flexibility there. So really, really great structure, and these can be set up for very, very low cost. All right. Now the next and the fifth one is what we call the earnings trade for a pairs trade. So this is a market neutral post-earnings strategy if you want to take advantage of a post-earnings trade. So what this does, this pairs trade or spread trade is a market neutral strategy that can be used and constructed for a post-earnings trend move on a stock after its earnings release. So by trading a pair or a spread, this helps to mitigate the overall market risk, okay? So it's a really cool strategy. So by simultaneously taking opposite positions on related securities, this allows you to reduce your exposure to the broad market movement. So in other words, a pairs trade is going to be equally likely they could profit whether the market you trade goes up, down, or sideways. It doesn't matter. All you're going to be playing is the spread relationship between two securities that are somewhat correlated. So you're going to learn in the course how to do this, how to select the trades based on the earnings, and then how to construct these trades using synthetic options So it makes it a really cheap, highly leveraged, but defined risk trade. Now, I'm going to show you an example here of one that was a spread trade set up for long Google and short NVIDIA. All right, so let me just show you the chart here real quick. All right, so here's the spread. Now, this spread relationship is going to be long Google and against it short NVIDIA. All right, so long Google and short NVIDIA. All right, so now let me back up. And so all you're playing, you don't care the market could go down, could go up, but all you're playing is the relative strength between the spread of Google and NVIDIA. And that's where you make your money or lose your money based on that relative strength. And you don't have to worry about overall market risk. All right, so here's 5 different ways that you can trade and make money. So think about this. So if you're just trading Google, and you're going long, you can only make money obviously if it goes up, right? So you could buy calls, or you could sell a put. But and if you wanted to go short, how do you do that? You would sell a call or buy a put. But if you want to do it as a spread or a pairs trade, where you're spreading 2 different securities together that have a correlation to some degree, then here's what can happen. So, for example, you could be long Google and you could be short NVIDIA, and you could have Google going up faster than the short Google, the short NVIDIA. NVIDIA could be going up, but not as fast. And Google's going up much faster. You see that spread widening. So that's where you're going to, so let's say you got in here at the spread at $10 right here, and that widens out to $100, okay? That spread. So you make your money. You've got a $90 profit from that spread widening, right? Or you could do it here if Google goes up, but NVIDIA goes sideways, all right? So that spread's widening, right? See that spread widen? So you get in here at $10 or something, all of a sudden this thing's at 200. Now you made $190 on that spread widening, and you don't care. The markets could be going down, could be going up, could be sideways, overall market direction, but the spread is strengthening between Google and NVIDIA. So what we're going to do in the course is you get your catalyst from the earnings, all right? I'll show you this example here in a minute on Google. Or Google, in this example, could go sideways and NVIDIA could go down. So Google could just go churn sideways, but NVIDIA could collapse. That spread widens, right? Okay, that's another way to do it. Or you could have Google going down, but it's going down more slowly than NVIDIA. So you could have Google, going down, but NVIDIA could just be collapsing to the downside, and that spread widens. Or you could have Google going up and NVIDIA going down, spread widens. That's the biggest, way to make the biggest profit like that. So that's, basically what a pairs or spread trade can do for you. But in the course, then what we're going to take it a next step further, we're going to make these things super cheap to put on using a synthetic pairs trade. All right, so instead of being long the shares, short the shares, instead of being long Google, long shares and short NVIDIA shares, we're going to do this with a synthetic long and a synthetic short. So we're going to structure this where you go long Google with the synthetic long and short NVIDIA with the synthetic short versus, long shares, short the shares. And there are a number of different great reasons for that. First off, it's cost a fraction of the cost of the shares. Plus, if you do this with synthetics, you don't have to borrow shares to short. So it's a really great way to do it. Lowers your cost. Also ends the hassle of borrowing shares. All right. So we're going to do this trade setup in the course as well. So you're going to have 5 different setups that you're going to learn in the course, depending on what the earnings release, what we're looking for as far as a pre-earnings trend, earnings release trade, or a post-earnings trend using a pairs. So here's a really good example to show you the potential for these types of spreads. So here's Google, and here's I call this earnings one. So this was back on July. Actually, when you do these, typically the catalyst was the earnings. So the earnings were on the 23rd. So that was after the close. So this spread was then set up the next day on the 24th. So right here. So you can see Google was trading right here on the 24th. It was trading about 194 right down here. Okay. Now look what it did. It had a great trend up, right? Just to show you that. Now the other next one was right here. Google had this earnings was on the 29th. So this would be set up the next day. All right. So here was the 30th after, after you can't set this up, after the close. So you have to do it the next day. So the next day, you can see Google had, let me erase this. Google went out here on the 29th. The next day it spiked up here and it was trading right here, 281. All right. So that is, where it was trading there, 281. Down here it was trading at 194. But I want to, point that out and then show you how the spread would work. So it had a really good trend, but look at the spread. Okay. So we're going to be long and we're going to be short NVIDIA. So here's what the spread would look like. So this is what it looks if you just compare the two charts. Okay. So here's Google on the left. All right. And here it was, this was on the 30th, trading right here, 281. And then here's NVIDIA trading on the 30th. It's trading at 206. All right. So here's your spread. So if you looked at, if you took 281 long and you short NVIDIA 206, that spread value would be at that point was $75. So that spread right there, long Google, short NVIDIA, that spread at that point in time was $75. Okay. So watch this. So here it is. So just outline this going back, first off, back to this actually should be the 20, hold on, I got this date. I'm gonna have to change this. The July was actually right here, July 24th, okay? All right, so this was July 24th, but anyway, on the July 24th, the spread was trading at $19. Okay, look at this. So that would be Google long, NVIDIA short. So on that date, on the 24th, the day after Google's earnings, that spread was at $19. Now look what happened. Then it went up here to 75, chopped sideways, and then look, right here, here's the next earnings was on the 28th. And hold on a second here. I think I've got that date in here. Let me check. Yeah, this should be the October the 29th was the earnings in October the 30th. So I've got that date in there wrong here. But anyway, so this should be October the 30th was right here. So it's trading at $75 a spread right there. Okay, so this would be Google long, NVIDIA short, and that was right here. That was October the 30th. All right, now then that spread blew out, and on Friday, the end of the day, that's where the spread was. It was at 142 on Friday, on the 9th. So from this trade back here, if you set this up, you stayed with it. This was on the 24th, July 24th. So from here, the spread was $19. And then on the 9th, on Friday, that trade, if you were still in it, was 142. The profit per spread was $123. So that would be if you did one spread, and we're going to do this using a synthetic option long short. So remember, one option contract's equivalent to 100 shares. So in this example, if you'd done the spread here, you stayed in it to here, you would have been up $123 per spread. That would be $12,300 per option contract. Or the other way you could look at it is if you'd gone long 100 shares of Google and short 100 shares of NVIDIA on this specific date, there's your spread, there's your profit there. But we're going to be doing this at a fraction of the cost using synthetics. And then if you'd done the same trade here, just for example, on the October that 30th, that spread was at $75. And then on Friday, that spread was at 142. So it was up $67 per spread, or $6,700 per option contract. All right, so that's the beauty of that, and it doesn't matter which way the market goes. You can see that the big spread blew out here, basically because of NVIDIA. Look at that, NVIDIA just collapsing to the downside. So you had here, you had Google going sideways, then up, but look what NVIDIA did. So here's kind of that spread, Google going like this, but NVIDIA going like this. So that spread really blew out. All right, so those are the things that we'll cover, those strategies in the course. And then here's just another number of earnings trades that we just did the last cycle, to just kind of go through some more examples. So started this service on the earnings side back on June 18th, 2019, man, it's been a while back. And through Friday, we've had, these are very, very selective trades that I send out. So don't send out a whole bunch, but very, very selective. And you'll learn in the course how to do these selections to make them very, very high probability trades. So we've had 149 closed out, 109 winners, 17 break even, 23 losers. So a win break even rate 85%. Again, these are unaudited, just kind of show you a summary there on those trades. And so here are a few that we've just done recently. This is one that we did. This was on Oracle. This was back in December. And so this was an iron condor spread that we set up for a big price spike up or down. And so it was trading here, set it up here 220, and then the next day took it off. It was trading here at 188. It had a collapse down. So this is one that we did on Oracle. And you can see here, it was set up right here. Set the trade up. Next day it was here. Volatility collapsed, but here's the trade. So this was a really perfect trade. This is based on the history of Oracle. The potential for Oracle has potential for big price spikes up or down. So we set this trade up based on a move of 6% up, 6% down, and we had a big collapse down. So it went from our cost of the trade, cost $175 to set it up, debit cost, and the spread width was 250. So the spread width between the spreads 250. The trade cost us 175. Again, this was done because the probability was for big price spikes up or down, and we got the big price spike down here, and it was down about what was it, down 20%. So we had a huge move down and ended up making the full profit on that. That was Oracle. Okay, 42% return, and you can see the Oracle had a big price collapse, went from 220 to 188.70. What is that? I should have had that percentage in there. So 220. So this had a collapse of 14% down. And we set the trade up. All I had to do was move 6%. All right, so that was one on Oracle. Here's the one I showed you earlier. This was another one we did in the last cycle. This was a firm, also looking for a big price spike up or down. So this one is where we set this one up here earlier. I showed you this one at 80. The next day it was at 88.45. So this had that big price spike up. And this one we ended up making, keeping the $50 per spread, 33% return. So this had a big price spike up to the upside. On this one, we had it set up. It didn't matter. It could go up or down. We didn't care. Now this is one that we did on Exxon Mobil for a double calendar, double lightning. And so it was trading. This one we were setting up for, a small move up or down. So this was the double calendar. It was traded at 98.15. And we set this up, and going out on the first, it was 111.06. So you can see here's a double calendar spread. Anyway, very, very detailed on how to do it. And then here it was on the first, it was up $45 per spread there. And that was, looking for a move up or down based on the implied expected move. So 98 ended up going up to 111.06. So not a big move, but perfect for the double calendar. And kind of went out inside it. See here, this is why these are so forgiving. See this zero line? So even with it trading here in the middle, we didn't get exactly where we wanted it. That would have been max. But even up here, we had a really tight spread. It's kind of like a butterfly. So you can see it still had here a nice little profit in it. So this was up, went from that spread was up from the cost of the spread was $118. And it went up and moved out to 175. So we had a profit of $57 per spread, or a 48% return. Okay, so that's with it not even hitting our max area to the upside or downside. And look at the break even. We've got really super wide break even. So these are, for certain situations, these are great because they're super low risk, but give you a really good return on your capital at risk. And then here's one more that we had done on Kavana, CVNA, another one for big price spikes based on the earnings history. So it's trading at 337.46, and then the next day took it off as trading at 367 2 days later. So right there. So this one blew out to the upside, and we made a max profit here of $60 per spread on that risk of, cost of 190, spread blew to 250, we make 60. All right. So these are what we'll cover in the course. And then with the alert service, these are the types of trades that are sent out. Now, will every trade be a winner? It'd be great if they could be, right? But they won't be. And if every trade you did was a winner, you get bored probably. But this is a way to systematically use this kind of system where you are going and scanning for these trades and then selecting the best ones based on the scans that I'm going to teach you, the 3 different scans, then selecting, putting those buckets together, the list that you get, and then how to, apply the strategy and set up the right one. So let's talk about the next move for everybody here, and we'll go through what you're going to get in this course and all the, different benefits from the 2 different course packages. So again, this course will be next weekend, the 17th. 11 a.m. Eastern to 2 or however long we need. Then we'll finish up on Tuesday, the 20th, 4 to 5. And then we'll do a dedicated Q&A for the course live and recorded the next day on Wednesday. So with this, you're going to, it's a 4+ hour course, total of 6 enrollment bonuses. Today, if you want to just do the course and a couple of the extras, it's $157. And so again, put in that powercycletrading.com/send or /special, and then EARN20 is the promo code, small cap. You'll get a 20% off the course price, and so you're going to get a great deal on this package today. So here's just a little feedback from one of my members that had taken this in the past. Mark said, Larry is a great teacher. I've had a few, and Larry is by far the best. I also enjoy his earnings course. I made 3 trades in the past couple of weeks. Larry would have been happy. I followed his teaching and traded Broadcom AVGO for 1,000% winner. I must say, I'm not sure if things are finally starting to click for me or if it's Larry's awesome teaching, but I'm trading better than I ever have traded in the past 3 years, close to 4 now. It's probably a combination. Anyway, I'm not tooting my own horn here. I just want to leave this comment that is positive for Larry. I've been through a lot of different programs, seminars, trading groups, etc. And what you're doing here is by far the best, in my opinion, Mark. So appreciate that. So here's the course packages. Option 1, if you just want to join us for the course for $157, which will be a $197 next week. With this, you'll get a 30-day trial membership to my trading club. You can start it when you want. Now, if you do decide to stay on with us, hopefully you will. It's $97 a month. We do have other packages, though. Then you'll get the follow-up live Q&A that we'll do on Wednesday, live and recorded. and then you're going to get my my scan, my best stock earnings list here. So you'll get that. But in the course, you're going to be learning how to do this for yourself. Okay, but you're going to get starting out this trade list. Okay, so you'll get all that. So total, course package 2,000 today, 157. Super good deal there for you. And then if you want all the bonuses, that's option 2. If you do want the other bonuses, would be the the 4-hour prior course that I did, so you can start out right away. 30-day trial membership, start trading options today. These are all website prices. Follow-up Q&A, the Greeks right here, and the trade list. So this is over 2,600. So this would be 197. All right. So if you've got any of these and you just want to jump in for 157, that's the way to go. But the other really great opportunity here, if you want to take advantage of it today, would be to do it with the alert package. Okay. So if you want my alerts for another, I think it was $60 or whatever it was, you can have the alerts and for very minimal cost to add on. So here's, you get my 5 trade alerts for 4 months. You can start and stop when you want. Plus you get the trading club for 4 months additionally. So these will be trades, could be a butterfly or long condor, could be a counter diagonal, could be a butterfly kind of pin trade, could be a reversal trades, credit spreads, could be a selective earnings trade. So those are the 5 different ones that'll be sent out. And then, I'll guide you through it, show you how to do it, walk you through it, keep you in the trade, manage the trade for you. And all you have to do is follow along. So that's what you're going to get there. So course package 2, option 1, this includes those extras that I showed you earlier, just the 30-day trial membership, the trade list, follow-up Q&A. So for today, if you use that code EARN20, this will be $478 only. If you break that down by the day, $2.68 just to add on the alert service. So super cheap. Now, if you want option 2, that gives you all the bonuses, just extra $40 here, $518 to pay for both. Okay, so that's everything you're going to get there. Now, when I send out a trade alert, you'll get the trading guide, exactly, the trade setup, the option trade strategy to use. Now, a lot of people that have my alert service, they just do their own thing. They just want the trades, and then they'll, do their own trade. Just go long the shares, go long option, whatever. But I'll always give you an option spread trade that I think's the best appropriate trade for, the market you're trading at that point in time. Then I do a trade setup video review that day after the close, kind of tell you more about the trade. Trades are listed in archive. You'll have access to my weekly live and recorded Q&As then for the next 4 months, my video newsletter for the next 4 months every day after the close, and then access to a virtual trading room during the week for the next 4 months, and a 50% discounts on anything on my website, courses, and all my trading models and indicators. So that's everything you'll get. And here's kind of the summary of alerts from last year, January through Friday. 138 closed out trades, 91 winners, 19 break even, 28 losers. So we have a win break even rate running about 80%, really high winning rate probability. These are unaudited, but that's kind of the summary, so you can get an idea what you're going to be looking at. And then from inception, when I started the first alert service, then I added on to them. But back May 2018 through Friday, 970 trades closed out, 689 winners, 74 break even, 207 losers, win break even, run high, 79% win rate, break even rate. So that's kind of what you can look for, unaudited results there. And then the earnings run about 85% win break even rate on that. All right, so that's everything there. We'll go through the course, what you're going to get, what we'll cover here in just a second. But again, use this link here and then plug in EARN20 small cap, and you'll be ready to go on that. All right, so what we're going to cover in the course is, here's an outline of what we're going to be starting out with. So we're going to go through first the 5 steps to the perfect trade setup. So we're going to go through the analytics that I use, how to do it, how to set up these screens, okay? So 7-step process I use for screening to identify the most probable winners. This is the most important part, really, of the course, and it is how to find the trades, the right screen to do. Okay, and then we'll go through the option pricing, the importance of weekly options, and then we're going to go through the resources I use, the statistics I use for the earnings history, what I use there. So I'll go through that, and then I'll show you how to use the scans, set the scans up, and then capitalize on the data, how to analyze the data, how to put the data together for that, how to analyze it, to set up your earnings release, post earnings move, how to set that up, select it, what are the best weekly option strategies that we're going to use there. And then my formula to create the efficient watch list. The biggest most important thing here really is your watch list and how to put that together, these screens that I do. And so, you'll learn that, how to do the screens, plus I'll be giving you those 3 screen setups to start with anyway. And then part 1 and 2, this is the live part of the course. This is where we'll go into the option strategies, the live part. Everything's being recorded as well. So we'll go through the iron condor, the high probability credit spread for volatility collapse. We'll go through how that works, when to use it, how it's structured. We'll go through the iron condor debit spread for the big price spikes, how wide, and then when to use that. And then we'll go through the double calendar, okay? So these are the 3 that we'll cover here. And then the other one that we'll cover is that post-earnings trade using the pairs trade. So these are going to be the strategies we'll use, and you'll learn then in depth how, why, and when to use this dynamic strategy based on my 10-step trading guide for earnings, okay? So details covering the earnings double calendar is a big part of the course as well. How to choose the optimal option price for this, how to structure the setup using the option expiration, and how to do that, and then how to adjust the double calendar into a free trade. So a lot of times what we try to do is, if we stay with a double calendar, let's say we stay with it for the trend to the next week or whatever, in certain situations, there will be times when we can actually end up adjusting this to a free trade by either converting it to a debit spread or condor or butterfly. So we'll go through how that works. It's kind of like a chess game, actually, to look at the steps involved there. So we'll go through that. And then part 1 and 2 is the live part, which will also cover the earnings pairs trade strategy. So this is that market neutral strategy that can be used for any post-earnings trend move on your stock after its earnings. Strategy will totally change your trading plan in favor during high volatility markets, regardless of market direction. So I've taught, many people how to do these pairs trades, and that's a lot of them. That's all they do now. It's just spread trades or pairs trade, because they're basically neutralizing the systemic risk from overnight risk by doing it as a pairs. So we'll go through how that works, the details of all that, how to identify the right trades for the setup based on the catalyst of earnings, kind of like the Google example, how to statistically measure pairs correlation. So this is another important part. How do you find the correlation between the two that makes the most sense to use or not to use? The resources I use for that, for correlations, and then when and how to set up the earnings pairs trade, and then how to lower your pairs trading costs doing the trade structure using a synthetic long short option structure to execute the trade. So really, really cool strategy. And then part 3 is a recorded part of the course, just to give you a little even more on this. So in the recorded part, also covers that long iron condor volatility credit spread, but also goes through the long iron butterfly, and again, that short iron condor. So you get a lot with this course. This is an additional part on demand, but this part covers in more depth these three types of trade setups as well, covering the long iron condor butterfly, which I don't go over in the live course. Okay, so all that is covered. And then the earnings option strategy guide. So this explains in depth how, why, and then when to use each of these types of trades with examples. How to construct the earnings trade based on your pre-earnings implied move, how to calculate the implied move, and then how and when to set up the trades, and then how to manage. You'll also get a really nice trading library of past trades you can go back and look at, which is a great way to learn these trades. So you're going to get a really great trading library with a lot of different trades. You can go back and look at these earnings, Apple, Google, just a lot of trade setups there. Here's another, really nice write-up from Mary, one of my members that took the course. They said the course explained in clear and simple terms how to trade options on stocks that were coming into the earnings report. Larry shows the specific sources of information to use to determine which strategy is the most appropriate for the stock that is reporting based on historical data. So important there. He gave very specific guidelines as to the use of each, and also exit strategies. Larry goes over the material in great detail, shows examples of strategies from past performance. One thing that impresses me with each course I've taken is his willingness to repeat explanations if someone asks a question or clarification for something. Larry schedules the classes for certain time frames, and because he wants to ensure each participant has understood the information, he most often goes over the planned time because he has stopped to answer questions thoroughly. So that pretty much sums it up. I'll stay until the last question's asked, so try to give you as much as I can there. And then here's enrollment bonuses. So first off, if you do course package 1, option 2, this one gives you all the bonuses. So this one you'll get the earnings option guide course. So this is actually a 7+ hour course that I did on demand. So you'll get this right away that you can dive into before we even do the class next weekend. So this comes with the recorded on-demand course, 428-page power trading manual of the entire course. Goes through all the different option strategies in the course, et cetera. So you get this, right away as a bonus, so you can get started and add it to your trading library. And then everybody will get my, if you do the package 1, you'll get a 30-day trial membership to the trading club. And what this gives you is your virtual trading room. This is 9:30 to 10:30 each during the week, Wednesday through Friday. Then I do my first Q&A. We start our Q&A on Tuesday, and so you'll have a live access to that each Tuesday, live and recorded. Then I do a daily video market newsletter, updates of the market, what we're looking at, what I'm looking at after the market closes, what we're looking at the next day, things like that. So you'll have that every night after the close. Traders Educational Vault. These are kind of some of the things you get with the trading club, and you're going to get this 30-day free trial if you do buy the course, and then 50% discounts on all course and trading software. And here's one of my old members here, Jay, said this is really kind of what I take away from this. Said reading books is fine, but seeing the actual option trade setup makes a huge difference. Thanks, Jay. So that's really a big importance of the trade room or coaching room there. So you'll get that, and you can start when you want, so you can wait until after the course. Now, the next thing, if you do course option package 2, you'll also get my Start Trading Options Today. So this is kind of a intermediate on beginner's option course. Takes you the benefits of options versus stocks, option basics you really need to know, mastering puts and calls, how option expiration works. And then in this course, it goes over 3 different option strategies: the covered call and the protected put collar strategy, and also the vertical debit spread. So you get that as a bonus here, and that's option 2 only. So that'll be available to you. And then for bonus 4, that's available to everybody. This will be the follow-up live Q&A that we'll do on Wednesday after the course, second part of the course on Tuesday. And then how the pros use the Greeks. This is for option package 2. This is a 60-page option guide with videos that covers the foundations of options. It really goes through in detail the Greeks, how to use them for your option trading, delta, gamma, theta, things like that, option pricing, market maker secrets, standard deviation, option delta, and trade probability. So a nice little bonus course there for you if you'd like to do that. And then earnings stock watch list, everybody will get this. So my initial scan, this is my 3 top earnings watch list, and this is based on the scan that I'll do, and I'll teach you this in the course. And these are based on, looking for those that move 5% or greater to the upside or downside. We'll do a scan for max of 7% up or down and a max of 5. And so you'll get this. And then in the course, the big part of the course too is then teaching you how to do these scans and how to analyze it. And then I'll give you, these are 3 lists. This is from the last course, last earnings cycle. This is list 1. This is for a max move of 7. So you can see what we came up with. We had, these all came up with a scan, the past 4 cycles, UAL, CSX, AXP, you can see kind of the various things, Valero, and it gives you, close, average volume, next earnings date, after the market opens or closes, or, before the market the next day. So you'll get that. That's list 1. List 2 is max moves of 5%. You can see here the last go around, we had PSX, AIG, EOG, and then the third list is a list for greater than 6%. So you can see things like this: DEC, Carvana, CVNA, Croc, Roku, Palantir. So that's the list there. All right, so that's kind of basically what you'll get with the course. And then here's the lead open to close service. Here's a nice, really great feedback from one of my members, Waleed, who lives in Kuwait. He said, Larry, I have to mention one thing. I'm subscribed to a lot of services who send out trade alerts. Some are good, others are not that great. But one thing I would like people on this webinar to know is that when I get a trade alert from Larry, I do it blindly as time has shown me. This man is dead accurate in his recommendations, Waleed. And then Dan, thanks for Dan, says you're very diligent, totally thorough with your analysis. That is the foundation success of your alerts. I paid for my subscription with the first 4 trades I took when I was learning just how to trade options. So that's a really great. A lot of members have done the same thing. They'll just follow the trades and they're learning as they go. All right. So with this one, if you want the elite open and close alert service, I highly recommend it today. $478 for the next 4 months. You're talking a little over $2.68 per day if you do the alerts. All right, so that's option 1. That gives you just the extras that I showed you earlier, the trade list, the Q&A follow-up, etc. Now, if you want with all the bonuses, then it's just $40 more. We're talking $518. So super great deal. And there's a 2-pay if you'd like that. So you'll get access to the 5 different type of trade alerts I send out, which can be calendar diagonals, butterflies, pinning trades that are based usually butterflies. I'll show you a couple of those, breakout reversal, kind of credit spreads, and then selective earnings trades. So that's everything you'll get. I always send, like I said, a trading guide when I send out. It could be the specific option trade, what that is. Trade setup video review is done. Trades are listed in archive. Then you'll have access to my weekly Q&As live and recorded for the next 4 months. My daily video newsletter, 4 months. Trading room for 4 months. Discounts and everything on my course website, trading software courses, 4 months. And you can stop and start, your service when you want by yourself manually, so you don't have to get us any help. All right. So when I do send out the option trade, I'll give you the entry level profit targets based on unusual option activity, what I call my price target mapping, what option series to use, stop loss levels and guidelines, and then all the trades are listed in archive. And then these are all sent out using the Telegram, which is a really, really great a free service that sends these things out within seconds. You can see here are a couple that I sent out last Friday. We had one Chevron here was going out at the end of the day. I sent out an updated alert that I said currently up around $226 per spread. Then I sent out another alert update on ON, the trade that we had on Friday. And so that's what it looks like. It's a free service, and these things come out within seconds. When I send it out, you've got it. So it's a really fast service. Then after the close, I do a trade setup video review. If there's a new trade out on the alerts, you get the daily video newsletter. We have access to the weekly Q&A, live and recorded, access to the virtual trading room during the week. And that's from Wednesday to Friday, 9:30 to 10:30, and then those discounts. So a lot that you're going to get with it. And so you're talking, $478. And here's just an update again on the alerts. So here are the counter diagonals. We've been doing a lot of these lately. Started this back in June of 2019. We've had 394 trades closed, 278 winners, 29 break even, 87 losers. So win break even rate really high, 78% win break even rate on those. And again, unaudited. So here are a few that we've done. Here's a couple that we just did last week. This was one that we did on the 5th of January on ON. It was trading at 58.70. And then here it was Friday on the 9th, it was trading at 62.60. So this was a calendar diagonal. And here's the trade entry price. It's sent out on Telegram on ON long, trading at 58.70. Daily volatility squeeze, daily cycle low retracement reversal off 21. So I try to explain the trade while I'm sending the trade out. Here are the target levels: target 1, target 2. Know your trading risk. Here was the trade I sent out by a diagonal. And you also get my what I call my trade cheat sheet that, if you have any questions on what this means, it takes you through and tells you exactly what this dialogue means exactly. All right, but here it says do this diagonal. And so it's doing this 23 Jan long, short 9 Jan, 58.61 call at around $1.85. That's where the setup was. Then the next day, we did an adjustment here and adjusted the short strike. We adjusted the short strike up to the 63 call, I believe it was. Yeah, we originally had the 58.61. It was moving up, so we adjusted up to the 63 call. Here was another adjustment on the 7th. It was trading at 61.50. We did a trade adjustment here where we sold for big profit the 58 long call, bought to open the 59. And so now we had the adjusted trade long, the 59 call, short the 63. And then on Friday, the first thing we did, we closed out the short 63 call, rolled that up to the 65 call, kind of going through this fast, but then here's the end result. At the end of the day, now it was trading at 62.60, and the spread that we adjusted to was up $161 per spread. All right, so it just shows you the detail that I go out and I send out. All right, so we did this trade here, set the entry trade right here on the 5th. These are based on my trading indicators, based on some screens that I did for this. And here it was on Friday, trading up here at 62.60. So here was the calendar diagonal on Friday going out at that level. This trade was trading right here. Okay, so went from our trade setup after the adjustment was we had the 59.65 at a cost of $2.10 or $210. And then the spread blew out. At the end of the day, it was traded at $371. We were up $161 per spread, or 76% return on Friday. So that was on. And then we did this trade, Chevron. We did this actually on Thursday, and it was traded at 157.25. And then Friday, this trade was going out at 162.20. So this was a really great trade setup, and we have really big profit in this one. So set this up initially at $250 and then you can see Friday was going out at 162.20. So this was up over $226 per spread on that. And here's the Chevron trade. So we bought this on Thursday. What we're looking for is this price spike here to be retested. Okay, so that was part of the reason the trade was set up based on that chart pattern. And then here's where the trade was Friday. So we went from 157.25 on Friday. We're out to 162.20. And so you can see the trade then went from 244 to 470. So it's up $226 per spread, 92% return on that Chevron trade. We're still long that trade right now. Here's another really great example. This was one that we did on Walmart, and this one was one that we did adjust to a free trade. So I'll just kind of go through that real quick. But this is a really cool trade setup. Long Walmart, it was trading at 105.50. And then on the 5th, it was trading to 115.60. So I'll just let me run through this. So this was just a beautiful trade. This was our trade we set up right here based on our trading indicators, based on the screen that we picked it up. Went long there, look at that trend, perfect upside. And then we ended up, this was so nice, we were able to adjust into a free call debit spread. So here was the initial trade setup. We had the long the 12 December 107, short the 5 December 112 at $1.74, blew out to 357. We were up 183 bucks per spread, 105% return. But we were able to adjust this then into a free trade and adjusted this into a call debit spread for no cost. We actually had a credit of $22. So now we adjusted this into a long call debit spread where we had $22 credit, and you can see it went out. We were closing out right in here, up $506 per spread on zero risk. Okay, so went from $22 credit, blew out to $484. So that was the trade there on Walmart. And then here's the butterfly condors. We do a lot of these. We'll do, this is the, updates there, summary of what we've done. 243 trades closed out, 172 winners, 22 break even, 49 losing trades. We're right about an 80% win break even rate on that. These are these can be, really huge winners. You can have 2-to-1 up to 25-to-1. I mean, these can be huge. These are, again, unaudited, but that's kind of a summary of what you can look at. These are very low risk trades, on average, maybe $75 of risk that you could potentially lose. Here's one that we set up. This was on Amazon long call butterfly. On the 25th, it was traded at 229.70. And then on the 28th, it was traded at 233. I'll just kind of go through this pretty fast. But we did this for a butterfly, targeting up here to 233, I believe it was. Okay, and so here was the trade. Right here's what we did. We were targeting actually 235. So we went out, bought the 230, sold the 235, sold the 235, bought the 240. So we had a call butterfly, $5 wide, so spread with the 5. Our cost on the trade was $1.21 debit, or $121 debit cost. Max risk was then that $121. Potential max profit, if we had a pin, would be $379 or 313% return. So these are, very selective trades, but this was set out as an alert trade. And we didn't get it perfect, but came pretty close. It's going out here. So it's traded at 233.11 on the 28th. So it went from 121. It was trading at 318, up 197 per spread, 162% return in three days there. That was Amazon. Now these are really cool. These are what we call our lotto ticket trades. These are typically butterflies. Here's one we just did on GLD. This one we did on the 3rd of December. GLD was trading at 387.90, and we were targeting to 400. And so here's where it went out. At expiration on the 19th, it was trading at 399.80. So this one was what we call a long binary call butterfly, okay? And so it's trading when we set up at 387.90. And here's the butterfly. So set this up at the 396, 400, 404 at around 25 cents. That's $25 per spread. And then here it was on the 19th. It was trading at 397 and a half, 65. And then here it was going out. It was trading at 399.80. This was up $375 per spread going out, 1,500% return. Okay, so these are really cool, very, very selective, but this was one that we just did not too long ago. Got in here, came right close to our pin at 400. So here was the trade setup. We did the 396 call long, short the 400, short the 400, bought the 404, butterfly there, 25 cents, 25 bucks total risk, spread width $400 wide, 25 potential, 375. If we get a pin there, that'd be a 1,500% return. We didn't get it perfect, came pretty close. Sometimes we do get it perfect. And here it was going out on that day, right there at 399.74. So went from 25 bucks to 331 bucks, up $306 per spread, 1,224% return on that going out. Now we won't wait for the very bitter end, but scale out, but that's where it went out. And then here's just one more just to show you. This is one that we had done on SPY, a put butterfly for a pin trade. So again, new SPY pinning trade. On this one, we were targeting down to, I believe, we did this butterfly targeting 560. So we did the 565, 60, 55, and we did this around 40 bucks. So here was this trade, and here it was going out at 561. This was up $232. So it was up 595% return. So set this trade up on the 6th, trading right here. We were targeting down to that 560 area. And here was the butterfly setup that we did, a put butterfly, 565, 560, 560, 555. Total cost, risk on this trade, 39 cents, 39 bucks, spread with 500, potential profit, 461. That would have been over 1,183% return. And this one went out. We had this one going out right, very, very close. This came pretty close to a pin. This was going out 560.32 right there. And so it went from 39 bucks to $456. That's a $417 per spread or a 1,069% return. So that's what you'll get if you do the alert service. And we just actually did another, we did a butterfly for GLD again. We'll see how it goes. We did a GLD call butterfly for potential pin next week. And we did this. This was our trade sent out this last, I think it was Monday or Tuesday to the members. And this was at 35 bucks. And you can see where it is currently. It's currently up a little bit. We've got, so just this was an alert trade that we just sent out. So this was a butterfly targeting 420. So we did the 416, 420, 424, 35 bucks, went out up about 12. Now, if this goes out and we got a pin up here, this will be up 300, and it's a $4 wide spread, 400 bucks less our cost, 400. So this has potential 400 minus 35 has potential to make $365 divided by our risk of 35. So this has potential to make over 1,400, 1,040% return potential, but we'll see where it goes. So anyway, that's it. If you have any questions, please let me know. Use this special link here and then use Earn20. And I'll look forward to seeing a bunch of you next week and also at the course. And this is a really fun course. All right, well, thank you, everybody. appreciate you being here. And again, one last summary here. You do course package 1, option 1, $157 today. That's 20% off. And with this, you get the course live and recorded, follow-up Q&A, 30-day trial membership to the trading club. You get the trading list, the 3 trading lists there. So that's what you're going to get. That's option 1. If you do want all the bonuses, then it's $197, just an extra $40. So $197. Now, I really, again, highly recommend that you jump on the alert service package here. So if you do this today, $478, that's like $2.70 a day. And that's, 20% off. That's what you're going to get. There's a 2 pay as well. That's option 1. If you do option 2 with all the bonuses, we're talking just $518. Okay. So appreciate everybody being here. That's what you're going to get. And the course will start again next Saturday, and we'll finish up Tuesday with a live Q&A the day after on Wednesday. So again, thanks everybody so much for being here. I will bid you farewell and have a great rest of your day, and I'll see a bunch of you next week. Thank you so much. Ciao.